A recession could be coming, and you're thinking the smart move is to put stop losses on your long-term, high-quality investments. Lock in your gains, protect your downside risk. Smart, right? Well, maybe. Maybe not. By the way, if you're not following me, leave a comment below. I'm not going to respond. It's just one way that I set boundaries and prevent people from taking advantage. Now, there's probably going to be a lot of whataboutisms in the comments below, like, well, what about this one? It went down and it never came back up. Sure, fine, but I'm talking big picture here. The decision ultimately is yours. So a lot of day and swing traders use a stop loss because a lot of these ultra volatile stocks can just dump really quick. And the idea is, I'm using my money to make more money by trading. Let me cut the losses before it gets worse, right? So for me, as a day trader who's been day and swing trading for 15 years, my stop loss is around 7%, but it's different for investing, and here's why. Long-term, high-quality investments, I'm talking about like, McDonald's, Nvidia, Apple, Johnson & Johnson, Procter & Gamble. These are stocks that could experience periods of volatility where the stock drops 10%. You might stop out at 10%, and then over the next decade, it could go up 100, 200, 300, 500%. Let's not lose sight of the long-term strategy here. Remember that your goal as an investor is to accumulate more and more shares over a lifetime. Maybe you start with 100, then you buy 25 more, 25 more, 25 more, and before you know it, 10, 20, 30 years later, you're sitting on thousands of shares. This whole game of like, I'm going to set a stop loss at 15% to protect my high quality investment that's going to go up hundreds of percent from losing 15% is a little short-sighted. Setting a stop loss sounds smart, but it almost always backfires when we're talking about a diversified high quality investment portfolio. The better move might be to stay consistent with your investing and to actually buy more during a recession. This is my recession investing wish list from 2008. The best way to build wealth long-term is to take advantage of recessions. That's why I'm a big proponent of having a little bit of money on the sidelines and writing down a list. This doesn't mean you stop investing. This doesn't mean you wait for the recession to come and then invest. You're going to time it wrong. Just stay consistent and keep investing. A lot of questions are usually like, I'm up 300% in a year on this ultra speculative stock. Should I take some profits? Again, it really depends. Did you put in way more than you were willing to lose? Then maybe, yeah, take some money off the table and use it to invest in other things. Did you only put in what you were willing to lose? Well, then who cares if it goes down 80%? You only put in what you were willing to lose. You were prepared for that. High quality company could drop 15 or 20% in the short term and then go up 500%. Don't be impulsive. You have to have conviction in what you're investing in, and you have to have a long-term focus.